Welcome to The Explainer. Today, we're diving deep into the very heart of the financial markets, and we're going to explore a really revolutionary idea that challenges, well, decades of classic economic theory.
So, is the stock market just a big random coin toss, or is there some kind of hidden order in all that chaos? For decades, a really powerful theory said, yeah, it's pretty much random. But then some mathematicians got their hands on the data, and what they found was a story that was way, way wilder, and believe it or not, more structured than anyone ever imagined. Okay, so let's start with the old guard, the classic view of the market. For a really long time, one big idea dominated everything, and that was the random walk. You've probably heard this quote before, right? From Burt Malkiel. A blindfolded chimp throwing darts could do as well as the experts. It just perfectly sums up the whole idea behind the random walk hypothesis. Basically, it's saying that trying to pick stocks is, well, a game of chance. Why? Because the market's next move is completely unpredictable. So, what does this theory actually say? Well, it's pretty simple. Trying to predict where a stock is going is basically like trying to guess a bunch of coin flips in a row. Good luck with that. In this world, today's price is the absolute best guess for tomorrow's price, and any difference between them? That's just random noise. And what's the engine driving this whole random walk idea? It's something called the efficient market hypothesis, or EMH for short. This was pioneered by Nobel laureate Eugene Fama, and it's a huge deal. The argument goes like this. You have millions of super smart, super competitive investors out there. Because of them, any piece of public information gets priced into a stock instantly.
So think about what that means. If all the known information is already in the price, then the only thing that can move the price is new, unpredictable news. And since news is unpredictable, the price changes have to be random too. See? It creates this really neat and tidy picture of the market, a world where most price changes are tiny, all clustered around the average, making this nice, gentle bell curve. In a world like that, massive market crashes, huge swings, they were seen as so incredibly rare, they were almost impossible.
But, and this is a big but, then you have these brilliant mathematicians, guys like Benoit Mandelbrot, who started digging into the actual price data, and what they found just didn't fit, not even close. The real market, it turned out, has a very, very wild side.
So is the market really that normal? Well, the evidence they dug up pointed to a pretty clear no. The reality of how markets behave is just so much more turbulent, way more prone to massive swings than those classic, tidy models ever let on.
Okay, this slide right here, this is the whole story in a nutshell. On one side, you've got the old model, the normal distribution. Prices just kind of glide along smoothly. Big changes? Super rare. And every day is a fresh start, totally independent of the day before. But then you look at reality, the heavy-tailed distribution. Here, prices don't glide, they jump. Big changes are way more common than you'd think. And this is absolutely crucial. Price changes are not independent. They cluster together. What happened yesterday has a real impact on what's going to happen today.
And just look at this. This is what real market data looks like. Just forget about that smooth, gentle bell curve. See how spiky it is? You've got these sharp peaks and these long, heavy tails stretching out. That is the market's real signature. It's the visual proof that those wild, extreme days happen way, way more often than the old theory could ever account for.
So here's the big takeaway. Price changes are not like a series of coin flips. They're not independent. The market actually has a memory. You see it all the time, right? A crazy, turbulent day is often followed by another one. A calm day is often followed by more calm. This is what Mandelbrot called volatility clustering. Basically, turbulence likes to stick around. Okay, so if the old math doesn't work, how do you describe this wildness? You need a totally new kind of math, a new geometry, one that's designed to find the hidden order inside of what looks like pure chaos. And that new math is called fractal geometry. It was actually invented by Mandelbrot, the same guy who spotted the problem. And the key idea, the real mind-bender here, is something called self-similarity. It just means that if you zoom in on a piece of the object, it looks pretty much the same as the whole thing. And this is where it gets really cool and kind of trippy. Just think about it. You pull up a one-year stock chart. You see all these jagged peaks and valleys. Okay, now zoom in on just 1 month of that chart. What do you see? The same kind of jagged pattern. Now zoom in again to a single day. Same thing. That essential roughness is always there. The patterns repeat no matter what scale you're looking at. That is self-similarity in the market, and it means the same fundamental forces are at play, minute by minute and year by year.
So, if the market isn't just a random walk, then what in the world is it? Well, this new fractal perspective gives us a totally different picture. It shows us the market as a complex, adaptive system. A system where, somehow, order emerges from all the chaos.
This idea of self-organization it's huge. Just picture a flock of birds, how they all turn at once. Or think about people walking down a busy sidewalk, somehow not crashing into each other. There's no one in charge, right? No central coordinator shouting, "Turn now!" The amazing coordinated pattern just emerges from all the little local interactions. And it turns out markets work in a very similar way. Because that's what the market is, right? It's this giant interconnected network. You've got millions of traders, investors, algorithms, all of them reacting not just to the news, but maybe more importantly, reacting to each other. And out of all those tiny individual decisions, these massive patterns like trends and bubbles and crashes, they just emerge on their own. And here's the thing about that network. It's not a democracy. It's not evenly spread out. It usually follows what scientists call a power law distribution. You know, the 80-20 rule? It's kind of like that. A handful of players or nodes become super connected and have most of the influence. And that's why the system can seem so tough most of the time, but can also be incredibly fragile if one of those few key players gets into trouble.
Okay, so how do we actually measure all this hidden order? This brings us to a really fascinating field called algorithmic information theory. Let me try to explain it simply. Imagine I ask you to describe the number 1 million. Easy, right? You just say a 1 with 6 zeros. That's a very short description, a short program. Now imagine I ask you to describe a truly random string of a million numbers. The only way to do it is to read out every single digit. That's a very long program. This basic idea gives us a way to measure complexity, to actually separate the meaningful patterns in the market from the purely random noise. Really, all this is just a fancy mathematical version of Occam's razor. The simplest explanation is usually the best. The goal is to find the shortest possible program, the simplest model that can describe the data we see. Everything that's left over, that's the real randomness, the truly unpredictable part.
So, okay, we've kind of torn down the old random walk model and built this new, much more complex picture of the market. What does this all actually mean for you? What are the takeaways? Well, looking at the market through this lens of complexity gives you a much more realistic view. For one, it tells you that news and company valuations, they're not the whole story. The internal dynamics of the market, the sentiment, the structure, that stuff really, really matters. It also tells us that because of self-similarity, prices can just keep meandering up or down, staying overvalued or undervalued for way longer than seems possible. And volatility, it's not some freak accident to be afraid of, it's a core feature of how the market works. But maybe the biggest thing is this: we usually underestimate risk. Those wild, once-in-a-lifetime events are actually baked into the system's DNA. So when you put it all together, you realize you have to move beyond simple A causes B thinking. The market isn't a casino where everything is random, but it's not a predictable machine either. The best way to think about it is as a complex, evolving ecosystem. It's alive, driven by feedback loops and these strange emergent patterns that come from all of us interacting together.
And that really leaves us with the big question, doesn't it? If markets really are this complex and fundamentally unpredictable, how are we supposed to adapt our strategies? And even just our expectations? It's a question that forces us to get a lot smarter about risk, and maybe a little more humble in the face of the market's incredible complexity.